Good evening, everyone, and welcome to our Asset Protection and Insurance for Rental Property webinar. We're glad to have you. So welcome and let's dive in. Just first of all, just an introduction. My name is Rachel. I am an advisor here at Marshall Reddick. Just a little bit about me. I have my BA from Business Administration from Vanguard University. My husband and I have been investors here at Marshall Reddick since 2012. So we were actually investors of the company for a long time before I came on as an advisor and a realtor here. So big believer in the company and just love what we do here. We own a few different investment properties that we are able to purchase through Marshall Reddick through the years. And I have a couple little ones at home as well too, a 4-year-old and 2-year-old boy. So they keep me on my toes and keep my coffee habit strong. All right, a little bit about Marshall Reddick. So we are a company with many different facets, a little bit of something for everyone, depending on what you're looking for. So primarily, first and foremost, we began as a real estate brokerage. So we help our clients buy and sell real estate, both in California and in our out-of-state markets across the country. For our clients who are located in a market outside of where they're purchasing their property, or for many who purchase in their own market as well as an investment, they want to utilize our property management skills and team in order to not have to self-manage. So that's another facet of our company. In addition, we're also a private money lender. So there's two sides to that department as well. We have the borrowers who are coming in, whether they are borrowing with a non-recourse loan or doing a spec build, all sorts of different non-conventional lending. We offer that. And then we also offer investors the opportunity to fund those different loans. So it's another unique investment opportunity that we offer. So no matter what you're looking for, we have something that can fit the mold. As far as our markets go, okay, so we have teams in 16 major metropolitan markets across 8 different states in the US. So as you can see, we have a great presence established in a lot of these different markets. Our Marshall Reddick markets are, we have our Southern California, Austin, Texas, San Antonio, Texas, Southwest Florida, and then Nashville and Clarksville, Tennessee, which also incorporates into Oak Grove, Kentucky. So many different investment opportunities. So a lot of our clients, you know, some of you out there tonight, I know well and work with on a regular basis. Others are fresh faces to me. So when my clients are coming in, a lot of them say, hey, Rachel, how does Marshall Reddick choose what market to invest in? So these are the different avenues that we take a look at when we evaluate a market in its strength. We have the job market, the vacancy rate, economic diversity, the housing affordability. Is it landlord friendly? That is a huge facet that's incredibly important, especially in this day and age. Strong education base, and is there reliable property management? So if you're looking at any of our Marshall Reddick primary markets, the answer is yes. All right, without further ado, it's my pleasure to make the introduction to Michael McAllister and Stan Dreckman. They've been working with Marshall Reddick since, you know, the early 90s. They're a long-running partnership with us. They are a preferred insurance vendor, extremely experienced, a very awesome asset to our clients and being able to evaluate, making sure their assets are protected. So they have some great information to present tonight. I'm looking forward to hearing what they have to say.
Well, good evening. This is Michael McAllister. I'm here with Stan Dreckman.
And good evening.
And as the slide says, we've been working with property managers over 20 years. I worked in real estate and property management for well over 20 years. And Stan's been doing insurance since...
a long time ago.
A long time ago. We'll just leave it at that. So we absolutely understand the insurance and the real estate and the fact that you're looking to cash flow on a property, but we're also looking at protecting your investment. So the purpose of your insurance, obviously, keep you out of financial loss if there's an event that happens, make sure that we can rebuild your property after the event and that you're not out of pocket any money so you continue to cash flow on your properties. So, structures on landlord insurance. Landlord insurance on 1 to 4 homes. It's going to cover your basic property, the structure. It's going to cover the contents of the interior. You're going to have loss of rental income, and we're going to get into that in depth a little later. Basically, that's going to protect you if an event happens on your property and your tenants have to move out. Then, of course, you need your liability protection in case you're sued. So what kind of claims are covered? Well, obviously your fire, wind, hail, and vandalism. You're going to have some coverage for broken pipes, and there's a whole lot of other items that are going to come into contact that we're going to talk about as we go along. But do note at the very bottom there it states flood and earthquake are a separate policy, and you have to have a separate policy in place. So if there's an earthquake, you need an earthquake policy. Same with flood.
Let me jump in on that. It's one thing to kind of help differentiate that. People think that a hurricane, which is a windstorm, also covers the water that rises and comes in the front porch. That's still a flood. That is not considered wind damage. So flood, most of the properties we see through Marshall Reddick are not in flood zones and just are not, it's not really that big of an issue. Every once in a while you see one, and so you do need a separate flood policy for that.
Okay, what kind of events are covered? Well, we're going to talk liability here because that's one of your most important ones. When you're sued, you're going to need the liability coverage. So let's say your neighbor slips and falls from a broken water line that's been running. This actually is a claim we have had. That's when you need to also start talking about an umbrella, that we will touch on an umbrella policy later. But also the very bottom one, if you look at that, if you're falsely accused for wrongful eviction by a tenant, you'll be covered by the liability coverage. But that's also another reason you're going to want a property manager. And we'll get into that as well. Now, a basic policy that you're going to see from most of your companies are going to look something like this. And this is a property we picked out that's available with Marshall Reddick. Gives you the basic idea of a one-story, recently built, 2,744 square feet. So you have your dwelling coverage, which is your replacement coverage. If something happened to the home and it burned down, that's the amount of money they say it will take to rebuild your property. Then you've got some personal property in there, loss of rental income, liability, medical, and a deductible of $2,500. That's a very basic policy you will see. And then we're going to go into depth on what you need to add to that to protect your asset properly.
And the reason we're going to do that is because you're going to find, listening to this, not all policies are equal. Like Michael showed you, they look alike on paper. But once you get beyond that cover sheet, they are tremendously different. Michael's going to go over some items here for you.
Exactly. Thank you, Stan. One of the things you didn't see on that last quote, does the replacement cost have an additional extended replacement value, or is it actual cash value? You're going to want the extended coverage, the extra coverage of 125%. We're going to show you what that looks like. Then you're also going to want building an ordinance that was not on the other policy. Super important, and I'll go over that in this next policy. This is what your policy should look like. So you've got your dwelling replacement cost, same amount. You have your extended replacement cost, 125%. Gives you an additional $88,875 to rebuild your home. Now, the reason that you want that coverage, if you've ever done remodels or you've ever done construction, you know costs run over. If it runs over and you don't have the extended replacement, it comes out of your pocket. So it's an important one to have in there. Then we get down to liability protection. In the last one, you had $300,000. This is showing you $500,000, which is what you want in place. And the difference from $300,000 liability to $500,000 is about $5 a year.
Yeah, it's a happy meal.
Yes, exactly. Then you're going to want the extended liability coverage for your property manager. And most property managers require this. This also was not on the other policy. And then you've got your law and ordinance at the very bottom. Now what that is, if your home burns down and the city, since your home was built, decides that you need a different GFI, that's the law and ordinance. The new ordinance says this GFI. If you don't have that coverage, the insurance company is not going to replace that part.
One thing I want to point out real quick, the property we're showing you here is a brand new property. What could possibly happen in a couple of years? Well, there's a thing called an Arctic blast that went through Texas, and I guarantee you homes built and improved after 2021 are all going to have different couplings for the outside of the home where the water comes in to the piping, because that's where they all blew. Texas homes were not built for that. They are going to be in the future.
Yeah, excellent example. So then you'll see the deductible set at $2,500 and 1% for wind and hail. We'll get into why that's a good number a little bit later. But the main thing to look at here is at the very bottom. You're going to save 5% if you package this with your primary home. So as you hear on all the commercials, package your insurance. It absolutely helps, especially with the landlord policy. If you save 5% off this policy, that's cash flow in your pocket. So let's talk about if you don't have the extra insurance. So here's a scenario where the home is insured for $355,000, and most programs will pay the $355,000 if it burns to the ground. So if you look at the bottom sheet here, you'll see the actual cost to rebuild the home was $386,000, including the building code changes, and you would only be insured for the $355,000 the typical company gives you. If you're with us and we do a Travelers or Safeco, you have the $125,000 additional amount, which gets you to the $386,000, and your policy's paying to rebuild that property fully. If you have the general policy that only pays the $355,000, where do you think the extra $30,000+ comes from? Out of your pocket, and you no longer cash flow. So properly insuring your investment is the most important thing you can do. So exclusions. I'll let Stan give you guys some exclusions because he knows all the exclusions.
Plus, I tell stories. Anyway, so yeah, we've shown you the glory side of the policy, all the stuff you need to have, and Michael was right in pointing those things out. The extended replacement cost, the building ordinance, those really complete the replacement cost. If you don't have that, you don't have the ability to put your house back together again and have it continue as an income generating asset for you. But there are some things that can happen to your property for which you can't insure it, or you can buy extra insurance, or you can get around it. So here you go. The first 4 items right here are perfect examples of all 3. Earthquake and land movement typically are not covered under a landlord policy. You have to buy that coverage extra through an outlet. Flood is also excluded under your landlord policies. Flood, just so you know what we're talking about, is the river's rising and the water's coming in, but the river can be the little river that's coming up the gutters in front of your home, and it keeps coming up and up and up and up and up, and it comes in the front door. That's a flood. It's exterior water coming in. We are not saying that if you have a wall pipe break and you flood out the interior of the home because of that, you're not covered. Quite the contrary. Again, flood is outside surface waters. Think heavy rainstorms, think tropical storms. Damage to freezing of pipes while the property is vacant. We're going to go to that a little further on as well. We always save the best for last. But this is an exclusion that can really cause you an issue. If you had a vacant property during the freeze this past winter, and your property was not winterized and you had a blowout, pipe burst, there would not be any coverage from the first day of vacancy. How do you get around that? Well, you can't buy extra coverage for it, but you can have great property management, and they'll winterize your home. That's what Marshall Reddick is there to do for you. Back up with sewers and drains. This is different than water damage. This is something that basically comes from the city lines that come right up your sewers, and they end up most likely in your bathroom on the first floor, and it gets to be kind of nasty. You want coverage for that. You can buy extra for that, but as a basic item, that is an exclusion until you buy it back. Pollution and mold, these are typical exclusions you've all seen before. Settling or sinking of foundations. If things move, we know it here. We're in a hot climate as well. The land moves. And if the land moves and it causes your house to adjust, that's not an insurable event. If you're not going to see very much of this third item, is damage to an unattached building. If you have a detached garage, say you buy an older home and Bubba is renting from you and he's running Bubba's auto repair service out of the garage in the back, there's no coverage if that building burns to the ground. You have to have him insure the building. That's an example of a business operating out of a detached structure. Dog bites. Dog bites can be problematic to you. That's something that no landlord likes. In a perfect world, landlords would never have dogs in their properties. On the other hand, if you have a family with a dog, you'll keep them there longer. So there's two sides of that same coin, but the insurance is very, very different from company to company. Some companies are going to completely exclude dogs, dog bites of any kind. Some are going to say, we're going to exclude certain breeds, and they're very specific. Some are going to say, we're going to exclude the breeds that the local municipality deems to be a vicious animal. Well, that can vary from municipality to municipality. Your property managers can tell you what it is. On our policies, we don't have animal exclusions, but we will underwrite up front. If you have an animal up front in the property like that, and you come to us, we probably will not be able to insure it unless we put an exclusion on a policy with a different company. But if you have our policy, tenant moves in, he's brought a dog with him, and he's your emotional support pit bull. We don't particularly like it, but we're on it. So you want to make sure you have a renter's policy for that. Next. Damage by pests. We actually had a situation. We had a marsupial, a raccoon, go through and raccoon out a house. A raccoon is not a pest. So if a raccoon destroys your home, it's covered. But pest, rodents, birds, other animals, if they get in there and damage the home, we're not going to cover it. We're not going to cover theft of anything that's not permanently installed. Maintenance, planning, zoning, municipal issues. If someone puts up a midnight patio cover and it's not been passed through the zoning and it collapses, we're not going to put it back up. Wear and tear, we never cover wear and tear. That's just considered home ownership and the cost of doing business. Your property management companies like Marshall Reddick can definitely keep that to a minimum. Here's kind of the fun point. This is what we like to point out because this is in policy, although various states are allowing certain things. But you will find an exclusion that says we're not going to cover the illegal manufacturing, production, or operation of certain kinds of plants or certain kinds of chemical manufacturing. So if you have a tenant that is making meth and he blows up the house, we could have an issue. You want to make sure your property manager doesn't rent to people like that. Here's how to kind of head them off. The tenant will not open the door to the property management company, or you did something really foolish is you accepted 1 year's cash advance on the rent, then went out and got a property manager. You could be in a world of hurt. You do not want to self-manage your properties. If you use professional property management, you're going to completely bypass this exclusion.
Good information, Stan. I want to kind of go into how we establish the replacement cost. We kind of touched base on it a little bit earlier, how we come up with the replacement cost and what it costs to rebuild your home. We do a lot of things. We look at the Marshall Reddick website so we can see the exact home. We go through Zillow, Realtor.com. We hit all of the internet searches so we can see the inside and the outside of the home. Then we take into the construction into the whole idea of putting together a formula. So you're going to have the square footage, the roof. Now, the roof's important. If it's 15 years or younger, we need to know that because a newer roof will get you a lower rate. Okay? We take into account how many bathrooms it has, if they're a full bath or a half bath, all the interior floorings we look at, fireplaces, if the fireplace has a chimney or if it's just a gas fireplace. It all adds into what we have to replace in the home and how much it's going to cost. So we'll look at the HVAC systems, basically everything on the interior and exterior of your home so that we can come up with a value of what it's going to take to replace the home. Now, liability insurance is a little bit different. And as we said earlier, we recommend $500,000 of liability coverage, and then also to get an umbrella to go on top of that. And we'll get into umbrellas in just a little bit. So your liability is basically protecting you in case somebody's injured on your rental property. Okay, and I can tell stories all day long of what we hear and what we see and why it's important to have this coverage and as much of it as you can. The liability insurance will defend you. It'll pay the claim. It'll pay for the attorney. It basically will get you to where you need to be through a court of law to not lose money and to continue to cash flow. A good example at the very bottom there is a trip and fall on your premises. Okay, we have had this happen, and the insured has had to pay out on this. And if you did not have $500,000, and the verdict came out at $350,000, and you have $300,000, that $50,000 comes out of your pocket. And once again, you don't cash flow. And we're here to tell you how to protect your asset and cash flow. So back to exclusions, because we always have exclusions to certain things and you need to know about them. For a liability claim, if it's an expected or intended injury, if you tried to do it or you had your friend do it to get hurt to sue, you will not get coverage. Okay? If you're breaking the law, you're not going to have coverage. Okay? There's various things. Rendering professional services. There are certain exclusions in your policy that you need to know about, and we go over with you. Okay, and then once again, any location that's not a scheduled location. So if you have a rental property and you own a rental property next door and you think that one policy will cover the other place, it does not. So that's super important stuff to know. Okay, you have other exclusions. You want to look at your HOA and get loss assessment coverage if you have an HOA, and that's basically if there's a unbudgeted event that happens, your insurance policy will pay for that, and it won't come out of your cash flow. Okay, if property damage that you own and you don't have landlord insurance, you're not going to be protected properly. Basically, if it's anything other than your rental property, you do not have coverage. Not up for a boat, plane, car. You can't have a daycare operation. And of course, once again, pollutants and fungi are not covered. Okay, let's get into some tips, because tips are where you really figure out what's going on in your policy and how you can properly protect yourself. So, special coverage limitations, okay?
This is a vacancy clause. Michael had mentioned this. This is a clause that can cause you grief, but usually it's not invoked because when you have good property management, such as Marshall Reddick, they're going to get a tenant in there right away. But you can have a property that's vacant. Typically, when you buy a property, particularly new one, it's going to be unoccupied. There's not going to be anybody in it. And you get somebody in there, everything is fine. Let's say you bought a property in Indianapolis and you closed on January the 15th. You might not have a whole lot of people looking to move in rather quickly. You could have that house sitting vacant for potentially 45 to 70, 80 days. Seldom happens, but it could. The point is, if something like that occurs, you start losing coverage after 60 consecutive days of unoccupancy. So you would lose vandalism, glass breakage, theft of damage to your property. If they stole the air conditioning units on the outside, wouldn't be covered. Fire and water damage, two huge exposures go away after 60 days. Now, something that you do need to know, and this is where we do everything we can not to have an exclusion hurt you. This exclusion, in most cases, is not going to apply while the dwelling is being renovated and being repaired and becoming rent ready. In other words, the clock doesn't start ticking until you've cleaned up after the prior tenant and you put it out to rent. So in the vast majority of cases, you have 70 days to put somebody in there, and you won't, under most cases, go near that distance. Just be aware of this, because it can be a very bad day.
Right, and just to put something on top of that as well, if you're at 60 days of a vacancy and you know you don't have a tenant going into the property, you need to contact us, your insurance agent, and we'll get you a vacancy policy. And that's a policy, it's going to be a little more expensive, but it covers your property for fire and water and all these items while it's vacant. Once you have somebody move back in, we'll get your old policy back into place so you can cash flow properly, but you do have the coverage.
Right. Now, we had mentioned frozen pipes. It's all about winterizing your property. So, again, as I had mentioned earlier, it's from the first date of vacancy. If you're in a cold climate, you've got to have that house winterized. You have to have, and winterized means you either have to have the heat going all the time, or you have to have the water drained out of the pipes. Your property manager knows this. That's why you need a property manager, if for no other reason than a cold climate. So we had a lot of these things going off in Texas, a lot of burst pipes. Again, in this, because it was Texas, most of them were outside the house, but they still allowed water to get in, but not like the typical ice angel inside of a home, say in Indianapolis. So this is something you have to be aware of. The solution to this, and this is how you completely go around, is like Michael said, call us. We can get something to temporarily handle a vacancy. Stay in touch with your property manager so you know that they're winterizing the home.
Okay, here's tip number 2. And a lot of times you'll run into an insurance agent that will say, I can get you a policy for much less. Well, that's danger number 1, because they might not properly insure you. And something like this, which is called actual cash value, ACV, that is a killer to an investment property. And basically what that says is if you have a claim, as you can see here, for $100,000, actual cash value takes depreciation into the valuation of how they're going to repay you. So once they figure out that the roof is older, the property has lost $30,000 in value, then they're only going to pay you $70,000 for your $100,000 claim. And where does that $30,000 come from? Out of your pocket. So you really don't want to ever have an actual cash value property policy.
Normally the policies you see that we'll sell you are not that way. Where you see these is a lot of times people get the idea they can make a killer in Toledo, Ohio, and buy a property for $40,000 or $50,000. It costs $200,000 to replace it, but they want to insure it for what they paid for it. That's a gamble. That's something only really sophisticated purchasers should ever walk into.
All right, tip number 3, deductibles. This is really something that we do on all of your quotes internally, but it's something for you to know. Your deductible is actually your friend, and you're taking on some of the pain of the insurance company making a payment when you have a claim. So we really find a 1 to 2 unit family home, $2,500 deductible is the way to go. A claim for less than that, you're probably not going to turn in because you don't want your rates to go up. Then when you get to a 3 or 4 unit, $5,000 deductible makes more sense. It'll give you a better rate at the end. And then your hail deductibles are typically 1-2%. We try to keep you around 1% when we can, but 2% when it makes sense in the rate. So where and what you buy affects your costs. It seems like it says exactly what it is, and it does. If you're in a hurricane area on a coastal area that might flood, your insurance is going to be higher. If you're in a tornado or hail zone, it's going to be higher. Some of the more expensive areas, Houston, Florida, Carolinas, Georgia, and the Gulf Coast. Now, when I say Florida, it's the east side of Florida. Marshall Reddick has stuff in Florida that's not in an area that we consider a more expensive area because it doesn't have the high number of claims. Take a look at lower rates. They're going to be in Austin, San Antonio, Clarksville, Oak Grove, Arizona, Boise, Florida. And if you see something in common on this list, that's pretty much everywhere Marshall Reddick finds your landlord places because they've done their research, they know what works, they know how to keep the rates down so you can cash flow. So what you buy affects your costs. A newer property, obviously, is going to have a lower rate, so you'll be able to cash flow better. The roof needs to be less than 15 years old. I kind of touched on that. And once again, it's just the insurance company knows that an older roof is going to have more of a chance of being damaged, and it's going to cost more to repair. Keeping it 3 to 4 bedrooms, 2.5 baths, up to 2,800 square feet is really like the soft area where you find that you don't have as many claims, and also your rates will be good. No pools, and lower no claims in the history because they run a clue report outside of California. Now, no pools is for a really good reason. Liability, liability, liability. I can't tell you how many claims we see from rental properties where somebody has a pool.
Yeah, there are some other aspects of rating that you all need to know about. Because, again, in California, we kind of live truly under the rose-colored glasses in the sense that what happens everywhere else doesn't happen here. Outside of California, they do what they call a claims history search. It's called an insurance score, and they're going to look to see what kind of claims have occurred to the property you're buying. If it's brand new, clearly it's a non-issue. But they look at the claims history, a small bit of credit, but it's usually wrapped up inside of loss histories. We look at them. Sometimes we'll see really interesting things. We see a clue report come up. If I see someone that's had hail damage, right, someone's looking to buy a house that had hail damage in April of 2016, I know I have a new roof, because that's what that was all about. That was a once in a 1,000-year hailstorm in San Antonio. So those are things that we know, but we will know based upon claim history and credit history how to properly price. Just like we get and we're also very similar to your lenders in that respect. You'll find that the better your FICO score, the better your loan's going to be. That also impacts your insurance. We literally have run rates side by side with people with different credit scores. We've seen sways of 50% in the premium. So your credit scores, your claim histories, those can impact your rate completely. Here's one. This is Michael's favorite, because he'd never seen anything like this until he got into the insurance business, where you can pay monthly, yet you can get the full annual discount because your mortgage company is paying it in full. So you do want to, in our opinion, as much as possible, impound or escrow, whatever words you prefer, your insurance premium along with your taxes into your house payment. Not only is it really convenient, but you get a better insurance deal out of it. And then the number of units, this is something where we really excel. We have a special deal with Safeco. We're one of a handful, if even that many agents that can write as many units in Safeco as we do. Most insurance companies don't like you to own more than 6 or 12 units. They're going to consider you to have a business. Those of you with the Auto Club have run into this. Those of you with USA have run into this. We can write as many properties pretty much as you're going to buy.
Okay, tip number 6. This is a big one and one that as a landlord you need to understand. Dogs are a challenge, okay? You need to require your tenants to buy a renter's policy. Renter's policies can run anywhere from $150 to $250 a year, so they're very inexpensive for your tenant, but they will have liability coverage in their renter's policy. Requesting their renter's policy, they get $500,000 of liability and not $100,000. So a few dollars more is all it is. Okay, avoid renting to a tenant with a dog or a biting history. The biting history is one of the most important things you can know. You have to have it on your application if you're going to accept the dog. Okay, some companies will still exclude it even if it's a support animal. As Stan pointed out earlier, we have ways around that in different companies we can use. But you need to be careful because certain companies, you may go out there and if you use a different insurance company than us, they may write you a policy and not tell you that all animals are excluded from the policy. Okay, it'll be in tiny little print. So the tip there that's highlighted, professional property management. If you have Marshall Reddick as your property management company, you're not going to have to worry about this. They look at the tenants, they screen the tenants, they understand all of this insurance. And then finally, the last one is a special liability market. If they have a dog that has to be excluded, we can get them a FIDO policy, which is a liability policy just for their particular dog. So tenants can be a challenge, as the dogs can. So once again, renter's insurance. I think you're getting the idea here. We're pushing them to get renter's insurance. It's super cheap and it protects you and your property. Okay, you're not responsible for their personal property. So if there's a kitchen fire and it burns down the living room and dining room as well, all their personal property in there would be covered in a renter's policy. You are not responsible to replace any of their property. Your personal property would be the microwave, the stove, and we include that in your policy. Okay, if a tenant is evicted and vandalizes the home, which can happen, especially nowadays when they're not happy with the landlord. Okay, a lot of companies will not cover vandalism, but Safeco will generally cover vandalism claim as long as it's vandalism and not normal wear and tear. Okay, loss of rental income. Now, I think this is super important because this is how you protect yourself. Okay, Most policies set the rental income at 10% of the dwelling amount. So as the example says, if you have $150,000 to replace your landlord home, you'll have $15,000 in rental income protection. And what that is when the kitchen fire happens, your tenant moves out to Red Roof Inn because they can't live in the home while it's being repaired, and you're not getting any rent from your tenant. Well, with this coverage right here, the loss of rental income, the insurance company pays your rent so you can pay your mortgage while your tenant's not living there while the claim's being fixed. Okay? However, if you think it's going to be more than $15,000 annually income, so let's say you're renting a place in California, we're going to want to increase this. We don't want 10%. Maybe we want 15 or 20% of coverage A, the $150,000, so that you'll have enough rental income to cover that claim time. It's very important.
Okay, this is huge, as we said here, huge. Keep your information current with your insurance broker. I cannot tell you how many calls we field and how many calls our Safeco reps field about a policy being canceled. And the number one, hands down, most common cause of an unintended policy cancellation is the selling of the loans between lenders, and no one tells anybody about it. You assume, and it's reasonable to assume, that everyone has been notified, but we are, generally speaking, the last to know. So if your loan is sold, please do not assume that we know that it's sold, because if we don't know, we're billing the other lender. And your policy doesn't get paid, it gets canceled, you didn't know it, and all of a sudden you have a claim, it's your 4 months into your new policy year, and there's no coverage because the policy canceled. You don't want that. And so make sure you update us with that. Also, update us with the bank's correct mailing address. For instance, if you look at your statement, the banks have separate mailing address for pretty much everything. We send them a bill to their general offices. That bill's going to sit there for a very long time. And when you move, let us know. Always update us and let us know, because we'll be sending you things to the wrong address if we don't know. And I like this one. When is $1 million less than $500,000? This is a liability coverage. Michael talked to you about the $500,000 of liability coverage that comes on the policies that we offer. Some of our competitors will use a more of a commercial approach. They have a split limit, $500,000 per occurrence with $1 million annual aggregate. We underline annual aggregate because it means they're not going to pay any more than $1 million under the policy no matter what. That is important because we pay on an occurrence basis. I think you're starting to see the difference. Theoretically, it's seldom going to happen, but theoretically you could have a situation where you have multiple claimants from a differing event, or at least the attorneys can prove that they're differing events. You could have 3 or 4 claimants come in on you. We would have up to $500,000 for each of them to pay and defend you on. These other policies, while they look really great, will cap out at $1 million on a year's time. So make sure what you're buying.
Okay, going back and kind of going over everything we talked about here on our tips, strategically use your deductibles, okay? And we talked about when you want $2,500, when you want $5,000, and we look at all that. When we're doing our quotes, we will put in different deductibles to see where the rate variance is the best. But not all insurance companies will do that for you. Coverage, make sure you do a comprehensive insurance review. Know what's in your policy. Ask us questions. We will go over it in detail with you. All policies are not the same. And I can't tell you how many times when people come to us and say, I have these 2 landlord properties, can you look at my policies? And the policies are just not protecting your asset. And so we'll have to go over it piece by piece and figure out how to get you properly covered and get your rate where you need it to be. And bottom line, professional property management. You are going to have so many problems if you are trying to manage a property in Arizona and you live in California, or if you're on the East Coast and you buy in Texas. You need a property management company to get your tenants in there, get the right tenants in there, address any issues, and keep you from having to deal with the tenant one-on-one. Marshall Reddick is one of the best I've seen at making sure your property has the right person in there, and any problems that come up, they contact us directly and handle any issue. If there's a claim at your property, Marshall Reddick will call us and get the claim started for you. So it's super important to have a property manager in place. And to add to that, if you have a professional property manager managing your property, you will get a discount on your policy. Okay, condominium and townhomes, a little bit different in the way their coverage is. Your typical condo policy does what's called a walls in. So the HOA will cover the exterior of the property, and then you're responsible for the interior of the property. So there is no such thing as extended replacement cost on a condo policy. You just have to look at your square footage, how nice the interior is, and how much it's going to cost to completely redo your interior. Okay. There are some other items. You can add loss assessment to be protected if the HOA has an assessment against the owners there. Also, your CC&Rs. Super important to read your CC&Rs. As I stated before at the very beginning, I did property management and real estate for over 20 years, worked with homeowner and condo associations. I managed several, so I know how to read CC&Rs. If you're not sure and you're buying a condo, send us your CC&Rs. We'll read through it, see what coverage you need and where the gaps in coverage might be.
I'm going to jump back real fast. We have the time. We're going through this pretty quickly. The loss assessment, that's something that doesn't have a lot of appeal to it. It's loss assessment. What is that? And Michael explained to you basically what it is. But let me give you a practical example. It's a nice quick story. We call it the happy dog story. We have, there was a family that had a single family home. It was not a condo. So loss assessment applies not only to condos, but to single family homes. And he was in a development, and his dog was incredibly friendly, and he wanted to go out and say hi to everybody. He liked it so much, the family was getting complaints, down to the point where the HOA got the family and said, you got to do something about the dog or get rid of the dog. Well, they locked the screen. They did certain things, but they had kids, and eventually the dog got out, and he was a happy dog. He wanted to say hi to the guy riding along on his bicycle. And he jumped up to say hi to the guy. The nice man is now a paraplegic as a result of the happy dog jumping up to say hello, because he was like a lab or something. He had some weight to him. If a poodle does that, we're not particularly worried about that. But you got a dog with some weight, it's going to be an issue. And the man was severely, the rest of his life, injured. The homeowners had $300,000 of coverage. That coverage went in a heartbeat. The insurance companies have loss committees. That check was written before that first loss committee completed their first meeting on this loss. They wrote a check and walked away. Homeowners Association was next in line. At that time, this was quite a while ago, the HOA only had about $1 million of liability protection. That went pretty fast. Guess what happens when the insurance companies pay limits? Not only, and there's still more to pay, not only do you all have to pay it, but you also still have to pay defense costs. So the HOA picks up the balance. They finally settled. There's $200,000 or $300,000 left over, and they assessed each and every owner their portion, however the CC&R say it's going to come out, on that claim. In other words, if you don't have this coverage, you want to talk about a bad day. When someone presents you a bill with $15,000, $20,000, when it could have cost you $10, $11 to insure it. Always, always, always. Some people try to save money on this one and don't want this coverage. Bad choice. Always have this coverage. Michael.
Okay. Let's talk about an umbrella policy. I touched base on it earlier. When I got into insurance in the very beginning and learned what an umbrella policy was, I immediately bought one. Everybody needs one. And when people say, do I need an umbrella policy? Yes, you do. Regardless if you're 18 and you only own a car, you need an umbrella policy. So what does an umbrella policy do for you? Well, it gives you additional liability limits. And it's just like it sounds. It's an umbrella policy, like when you open an umbrella. It covers all of your assets. So it will cover all of your vehicles, your primary home, all of your rental properties. So if you have $250, $500 liability on your auto, It maxes out at $500,000. Your umbrella policy will kick in for any claim over $500,000. Same is true with your home. Same is true with your landlord policies. I think you saw earlier where we talked about a slip and fall when the sprinklers were on at night. We actually had a claim where a lady, a renter, went out in the morning to get her newspaper, slipped on the grass that was flooded with a broken sprinkler, and fell down, broke her collarbone, broke her arm in several places. She was a professional violinist. After a few surgeries and out of work several years, the claim closed around $800,000. So it ate up the $500,000 on the landlord policy, and thank goodness they had an umbrella that kicked in and paid off the entire claim. If they did not have an umbrella, everything over $500,000 would have come out of the insured's pocket, and you never cash flow on that property again. Okay. Most umbrella policies are simple excess policies. They don't cover additional things. We at Safeco offer you what's called a real umbrella policy, and that will extend worldwide for liability. It gives you just the additional protection on umbrella you want. So I would recommend anybody on this phone call needs an umbrella policy. Call us, call your insurance agent. They're relatively inexpensive. They run about $1 a day, so about $360, $400, depending on how many assets you have a year. So something you definitely want to do. And then we're back to talking about what your umbrella covers. And like I said, it covers all of your stuff, your homeowners, your vacation home, any and all of your autos, your rental properties. Typically, you need to have $300,000 of coverage to get the umbrella, but you always want the $500,000 to stack on your umbrella. You can get a $1 million umbrella policy very cheap. You can also get a $3 million for just a few dollars more a year, all the way up to a $10 million umbrella with us. Okay? And when you get to your umbrella, guess what? You get a discount on all of your other policies. So your homeowner's rate goes down, your auto rates go down, and you get the additional liability coverage.
Well, that pretty much gets us toward the end here. This is something we'd like to share with you right now. We highlighted two companies. Safeco is our prime company for our program. Travelers is new to us. We've had them for about 1.5 years, but they've turned out to be quite a nice company as well. With our Safeco and our Travelers programs, you have, as a part of your insurance program, access not only to us, clearly, but you have direct access to the insurance company. We are not always available. We may be on the phone talking to somebody else. It may be after hours, and who knows? Claims don't happen from 9 to 5. You can call, in this case, the Safeco line direct, and that's our number, by the way, from the standpoint that when that number comes in, they know that you're with Huggins Dreckman Insurance. This is our number direct into Safeco, and then you just follow the prompts. What you need, is it a claim? Do you have a question for a bill? You want to make some changes? Your lender changed, you want to make that change, you can call them. You might want to do it at after dinner, 8 o'clock at night. You can call them and do it whenever you want to do that. So this is nice. With Safeco, you also can do online. You can be as antiseptic as you want to be, or you can be as gregarious and give them a call. I call them on New Year's and Christmas Eve just to say hi. And then this is our Travelers side. The Travelers side also has a line. That is not our private line. That is a general service line. Again, it's available to you for 24/7 live service. One thing I do want to point out, and it is critically important for you to understand this, not every Safeco or Travelers agent will offer this to you. We do. And it doesn't cost you a cent. We pay for it, along with the insurance company, obviously, but we pay for it. We take less money on our commission so that you can have the service. Why would we do that? Because it's better for you. We figure the more you like us, the more you'll buy from us. It all averages out. And this is something that we also want you to be aware of. Michael mentioned it. This is a quick follow-up to what he said. We just don't ask you how much you pay for the property and slap an insurance quote on there. We want to know. We want to know a lot of things. And our program is consistent as humanly possible from state to state. We check sources. We check inspections, whatever we can to make sure we're quoting this thing correctly. Safeco and Travelers are industry leaders. Leaders. Where'd that word come from? Leaders in this program. We literally are the competition.
Okay, so some additional program features that are offered. We keep pace with property replacement costs. I think we've kind of let you know all the research we do. We continually look for additional ways to make sure you're properly covered. Protect the rental income. If you're not cash flowing, you're not going to be happy. We understand how Marshall Reddick works. They're an awesome program, but part of it is you need to insure your assets so that you're protected, but also cash flow. Inspect your property's exteriors. On most of these properties, we will have a person go out and inspect it after the policy is issued. Then if there are any changes needed, we can address that. Okay. Discount on a new roof. Make sure when you're buying a property, you ask your real estate person, when was the roof last replaced? Okay. And I'm going to just throw in there property management. Make sure you're getting a property manager for your place. Okay. And then again, once again, we have the deals with Safeco 24/7. We have our own direct line. They will answer at Huggins Dreckman. They're at Safeco. We also have a phone number for travelers that's 24/7. And Safeco can quote and issue 7 days a week, 24 hours a day. So if I gave you a quote for your property and you like your quote, but say it's 11 o'clock at night and you want to place that policy right then and there, you can call Safeco. They'll issue the quote that I gave you. So then also we have 2 offices here in the Orange County area, one down in Los Alamitos, one up in Anaheim Hills. You can call us anytime. Stan actually probably works 24 hours, 7 days a week. I'm a little less than that. But you have our information there and our extensions. We are available for your questions. Just reach out to us.
Thank you very much for listening.
Thank you. And Rachel, I think you have some stuff you are going to go over.
Yes, thank you so much for that info, gentlemen. That was very helpful. Good to know how we can make sure that all of our clients' assets are totally protected. That was very insightful. Thank you so much. Okay, just to close this out real quick, for those of you I haven't worked with personally, or those of you who don't have an advisor presently, I just wanted to give you a high-level view of what you can expect when you partner with an advisor at Marshall Reddick as you are either beginning your investment journey or expanding your current investment portfolio. So we go over the the why, how, when, what, where, and who. So why, obviously we'll do some goal setting about what brought you to Marshall Reddick, what you're looking to accomplish here, and what you'd like to achieve with your portfolio. For how, we'll evaluate the different options. You know, as we mentioned, we're in 16 different major metropolitan markets, but we have our 5 Marshall Reddick direct markets, so we can evaluate the different options that are the best fit for our clients. When, we decide on the time frame. Obviously, that's very important with the investment journey. What, we'll set your criteria. Are you looking for a single family, a multifamily, you know, a duplex, triplex? Are you looking for a new construction, a established community? We can help identify and get you plugged into exactly what you're looking for. Where, so the markets themselves, not only in the greater metropolitan market you select, but within those markets, there's quite a few sub-markets. So, you know, depending on, say it was San Antonio, there's many different cities within that greater metropolitan market. You can identify what's the best fit and what fits your strategy the best. And then who, last but not least, I or the advisor you work with, I would be introducing you to all key players within the process within Marshall Reddick, get you connected with a local realtor within the market of your choice, and then the 3 of us will work through the process together, and then pulling in and identifying outside partners such as Stan and Michael to make sure you're properly covered and taken care of. So feel free to reach out. My information was sent out on the email for the event tonight. I know I spoke with a lot of you leading up to this. This is my cell and my email. Feel free to reach out. I'd love to connect with you, get you connected with Stan, and make sure your assets are protected. So with that, thank you guys so much for coming out tonight. We appreciate your time and hope this has been an informative presentation. Thanks so much, guys.
Thank you.
Thank you.